Strive Inc., trading under Nasdaq ticker ASST, is in the middle of an absolute intraday explosion. As of 10:01 a.m. Eastern Time, the stock is trading at $1.4599, a staggering jump of over 32.7% from its last close. But the price isn't the story. The volume is. In the first 30 minutes of trading, over 366 million shares have changed hands. To put that in perspective, its total volume all of last Friday, which was also a big up day, was around 247 million shares, and on normal days just last week, it was trading a few hundred thousand. This isn't just buying, this is a stampede. And while many new eyes are seeing this as a new opportunity, the truth is this price action is the climax of a brutal, month-long war between speculative bulls and a massive entrenched short position that is now clearly in a state of panic. The common belief, the expectation, is that a stock moving this fast on this much volume must have released some transformative news, perhaps a buyout, perhaps a miracle product. But that's not what's happening. The reality is that Strive Inc. is a company with a chaotic recent history, deeply negative fundamentals, and an extraordinarily high percentage of its float held short by traders betting on its failure. This 366 million share surge isn't about fundamentals, it's about leverage. It's about a massive short squeeze. The stock was trading over $8 in mid-September and collapsed to under $1 by mid-October. The shorts piled on, believing it was headed to zero. Today, they are being forced to buy back those shares at any price to cover their positions, and that forced buying is what you're seeing in this 32% price spike. Let's look at the recent trading. This is not a stable asset. This is a battlefield. After plunging more than 84% in a 30-day period ending mid-October, the stock found a floor around the 0.80 to 0.90 level. Then, last Friday, it suddenly ripped 27% higher on that massive 247 million share volume. Now, today, we are seeing the follow-through. This is classic squeeze behavior. The resistance levels have been obliterated. The intraday high is already $1.54, and the low was $1.35, meaning it gapped up and just kept running. Anyone who tried to short this morning, thinking Friday was a fluke, is already deep underwater. The algorithmic traders are fanning the flames, front-running the buy orders from covering shorts. This is pure, unadulterated volatility, and it is completely detached from the company's actual business. This brings us to the most critical part of this story, the short interest. This is non-negotiable for anyone even thinking about touching this stock. Data from the end of September showed a short interest of over 21 million shares. More recent reports from data providers like Fintel pegged the short interest as a percentage of the float at a staggering 42.4%. That means nearly half of the company's available trading shares were being used to bet against it. But the real killer is the cost to borrow. That same Fintel report in September showed the borrow fee rate, the annual fee short sellers must pay to hold their position, had skyrocketed to 143.04%. This is not a typo. Shorts were paying an annualized 143% interest just for the privilege of betting against ASST. This is a sign of extreme desperation on both sides. The shorts are so convinced it's worthless, they are willing to pay usurious rates, and the longs, or the share lenders, know they have the shorts trapped. What's your take on this? Is this a genuine turnaround or a classic short squeeze trap fueled by that 140% borrow fee? For investors, this is what you must understand. You can track this data yourself. Go to the Nasdaq website or a high-level data provider and look up ASST's short interest. Don't just look at the percentage, look at the days to cover. As of the last report, it was around 1.38 days. Today's massive volume will push that number down, but it shows the shorts were trapped. You must also check the options chain. A surge in near-term call option buying is likely adding fuel to this fire, as market makers who sell those calls have to buy the underlying stock to hedge their position, creating a gamma squeeze. You can also check the SEC's fails to deliver, or FTD data. When FTDs pile up, it can suggest that shares aren't even available to be located for legal short sales, a sign of extreme stress in the market for a stock. The bear thesis here was simple. The company is fundamentally broken. The short sellers looked at the balance sheet and saw a clear path to insolvency. They just got caught in a technical hurricane. Do not chase a squeeze like this, believing it's the new floor. The people buying at this level are often the last ones in, and they provide the liquidity for the shorts to finally escape. On social media platforms like X and Reddit, the chatter isn't even about ASST's business. The entire discussion is about the squeeze, the volume, and the macro environment. Retail traders are rightly pointing out the massive off-exchange dark pool volume in recent weeks, questioning the transparency. But this stock is also moving against a wall of macro anxiety. The Federal Reserve is set to make its next interest rate decision on October 29th. The market is nervous, and we've seen defensive repositioning in other sectors. A speculative, zero-revenue stock like ASST is the antithesis of a defensive play. It is pure gamble on market mechanics and Fed liquidity. So after all that, what does Strive Inc. actually do? This is where the story gets even more chaotic. Until September of this year, ASST was a completely different company called Asset Entities Inc., which was in the social media and Discord marketing space. On September 12, 2025, it completed a merger and changed its name to Strive Inc. This new entity, according to its own press, is an SEC-registered investment advisor managing over $2 billion in assets through ETFs, with a new pioneering mission to become a Bitcoin Treasury asset management company. This sounds significant, but just 1 month later, on October 16th, the company, now called Strive Asset Management, announced another all-stock merger, this time with Semler Scientific, and simultaneously announced a plan to allow insider share sales. This is a company in complete strategic flux. It has changed its entire business model twice in a matter of weeks. And the fundamentals are, to put it mildly, non-existent. Financial data from 2024 shows a company with annual sales of just $630,000 and an operating loss of $6.4 million. More recent analysis from just 11 days ago highlighted that the company has negative equity, resulting in a price-to-book ratio of negative 9.5x. This means, according to its own books, the company's liabilities exceed its assets. It is fundamentally insolvent. The short sellers weren't wrong about the business, they were just wrong about the timing and the mechanics of the market. Given the fundamentals show negative equity and near zero revenue, comment below what you think the real value of ASST should be, ignoring this squeeze. This brings us to the future outlook. The expectation, if you just read the headlines, is of a new Bitcoin-focused asset manager. The reality is a corporate shell that is unprofitable, has negative equity, and is undergoing chaotic back-to-back mergers that are likely highly dilutive to existing shareholders, not to mention the planned insider share sales. The only catalyst driving this stock is the short squeeze. The risks are profound. Once this short squeeze breaks, the price will have nothing to hold it up. The fundamental value is likely far, far lower than even its pre-squeeze price. The macroeconomic pressure from the Fed's higher-for-longer stance is poison for speculative, unprofitable companies like this. In the end, Strive Inc. is the perfect example of the 2025 market. The market expects a growth story, a new tech venture. The reality is a brutal technical fight over a fundamentally broken company. The expectation is that 366 million shares of volume means smart money is piling in. The reality is that this volume represents panic, forced covering, and algorithmic trading all colliding at once. The squeeze may continue. It may burn higher, but it is a fire fueled by gasoline, not solid wood. When it's over, the drop will be as fast as violent as the climb.